The vast majority of people are getting zero tax benefit from their charitable giving. But in this video, I'm gonna show you a simple strategy that ensures your generosity not only makes a difference in the world, but also lowers your tax bill. And stay tuned until the end because I'm gonna cover a special type of investment account that you can pair with this strategy to supercharge your giving even further. I'm Jordan Nitzel, the founder of Trek Wealth Planning, and we help you make smarter money decisions. Okay, before we get into our strategy, we first need to understand how itemized tax deductions work. Charitable contributions are an itemized deduction, and the other two most common itemized deductions are state and local taxes and mortgage interest. Itemized deductions can reduce your taxable income for the year, but only if the total of those itemized deductions is more than the standard deduction. Now, the standard deduction for a married couple filing jointly in 2023 is $27,700. So if a married couple's itemized deductions don't add up to more than $27,700 in 2023, then they're going to take the standard deduction, which means they get no tax benefit from those itemized deductions, including their charitable giving. How do we solve this problem? By bunching our charitable contributions together. Bunching your contributions refers to making multiple years of charitable contributions in 1 year. By doing this, you're more likely to have itemized deductions that are greater than the standard deduction. Let's look at an example which will make this clear. We'll take a married couple in the 24% federal income tax bracket. We'll assume they get the full state and local tax deduction, which is capped at $10,000 per year. They're gonna pay $10,000 in mortgage interest, and they do $6,000 per year of charitable giving. They have no other itemized deductions, which puts their total itemized deductions for 2023 at $26,000, and we're going to assume a similar amount for the next 2 years as well. As we just discussed, the standard deduction in 2023 is $27,700, which is more than their total itemized deductions, so they're going to take the standard deduction. That means they have $18,000 of charitable contributions over the next 3 years, which they get no tax credit for. Now, what if they made those 3 years of charitable contributions in 1 year? Well, now the total of their itemized deductions in 2023 is $38,000, which is $10,300 more than the standard deduction. So they can take an additional $10,300 off their taxable income for the year, and at their 24% tax bracket, that means they're going to pay $2,472 less in federal taxes. The next 2 years, they won't be making any charitable contributions, so they'll take the standard deduction as they would have been doing anyways. So they contributed the same amount to charity over 3 years, but they saved $2,472 in taxes just by bunching those 3 years of contributions into 1 year. And they can repeat this every 3 years and continue to get that tax benefit. This example, we bunched 3 years of contributions together, but it could have been 2 years, it could have been 4 years or more. The point is that you're grouping your contributions together in order to reduce the portion of the overall contributions that fall below the standard deduction line. Also, in this example, I assumed that the couple had the money available to make 3 years of charitable contributions in year 1. Now that's an optimistic assumption, and I realize that most people don't have that much cash just laying around to give away up front. So if that's the case for you, you can do this same strategy in year 3. Rather than giving money to charity in years 1 and 2, you put the money that you otherwise would be giving into a savings account or a taxable investment account, and then you give it all in year 3. Hey, before we go on, I want to mention that I have another video coming out next week going over another charitable giving strategy, which will cost you nothing, but could save you a ton of money in taxes. You don't want to miss this one, so be sure to subscribe and stay up to date. So we can see the clear tax benefit of bunching our charitable contributions together. There are a couple of issues that you may be thinking of though. What if I don't know which charities I want to give 3 years worth of contributions to right now? Or I prefer giving monthly rather than one big gift every few years? Well, that's where a donor advised fund can help. A donor advised fund is a kind of personal charitable investment account, and you can open one at most of the same places you can open any investment account. When you contribute money to this account, you're making an irrevocable gift to charity. You can't pull money out of a donor advised fund for any purpose other than giving it to charity, but because it's irrevocable, you're eligible for an immediate tax deduction on your contribution. You can invest the money within your donor advised fund, and any growth is completely tax-free, which means more money that you can give to support your favorite charities. Over time, you can direct the money within your donor advised fund to your charities of choice. This process is known as recommending grants, and it can be a one-time gift or a recurring donation. Now, the charity you're supporting needs to be an IRS qualified public charity, which would include most churches, universities, and other 501c3 organizations. Ultimately, the final decision of whether to approve a recommended grant lies with the sponsoring organization, which is typically whoever you opened the account with. But if it's going to an IRS qualified public charity, the recommended grant will usually be approved. Now, it's important to note that you don't get another tax deduction when you send money out of your donor advised fund to the charities you're supporting, because you already got that tax deduction up front when you put the money in the donor advised fund. Donor advised funds are great to pair with a bunching strategy because you can give your large multi-year charitable contribution to your donor advised fund, which gives you an immediate tax deduction, but then you can still decide where to give that money later. So if you don't know which charities you want to give to yet, no problem. The money will stay in your donor advised fund until you decide, plus you can invest those dollars and potentially get some tax-free growth in the meantime. Also, if you still want to give to your charities on a monthly or annual basis, that's also really easy. You can send money out of your donor advised fund on a recurring schedule, either monthly or annually, the same way you could if you were giving out of a bank account. So overall, bunching your charitable contributions together, utilizing a donor advised fund, equips you to be a more strategic and tax-savvy philanthropist. As I mentioned before, I have a video coming out next week that will give you another tax-smart giving strategy. You can use it separately, or you can layer it on to a bunching strategy, even further reducing your tax bill. So make sure you subscribe to my channel so you don't miss that one or future videos that are going to help you make smarter money decisions.